How's it going, friends and family? My name is Amos, and welcome to another episode of the Cheese Public Portfolio series. In this video, we'll be going over number 1, the new position that has joined the portfolio. Number 2, answering the question to the ideal number of holdings in a portfolio. And last but not least, number 3, the notion, the idea that great stocks, great businesses, they often require boring amounts of patience. So if that sounds good with you, let's go ahead and get into it. Yeah, can I get a dividend compounder with cheese? Thank you. So in the last episode, I revealed that I sold half of my positions. Why? Because I had to free up capital for the upcoming move back to the United States. By the way, so much going on, a lot of stress. However, it'll all be over in a matter of weeks. At the exact same time, a few opportunities came up that were simply too good to pass up. So it's kind of like making a Costco run. You know what I'm saying? Where you have like a grocery list of I'm only going to buy some baby back ribs, maybe some salmon, and a thing or two. But then as you push your shopping cart, you glance over to the men's clothing section. There's a deal that's just too good to pass up. That's exactly what happened. And no, I did not stutter. I did say there were a few opportunities, which I did buy into, but for now, I'll only be sharing with you one position. The rest of them will be available on the Patreon for the time being, but in future uploads, I will disclose what they are. But anyways, taking a look at the portfolio as it stands today, the total return 121% all time. And as we jump on over to the holdings tab, you'll see which one it is, and it's going to be Abbott Laboratories, ticker symbol ABT. And as it stands right now, I have 45 shares and an average cost basis of $90.41. They're currently trading for about $84. So I'm down, 6.7% or $272. So why did I buy into Abbott? And to answer that, we got to talk about what exactly do they do? How do they make revenue? So Abbott Laboratories, they have various lines of business. They sell medical devices, they sell pharmaceutical drugs, and they also sell nutritional products like baby formula, Pedialyte. You know, when you're super dehydrated after running a marathon, you can drink a Pedialyte, you'll be good to go. And they also sell meal replacement drinks, protein drinks. And if you take a look at their financials and fundamentals, this is a company that is just absolutely outstanding across the board. But as it stands right now, the medical devices sector, everybody is getting punished. When we talk about Medtronic, when we talk about Boston Scientific, when we talk about Stryker, and of course, Abbott. So for me, I saw it as a really good opportunity to finally buy into a very high quality dividend compounder with cheese while they're unfavorable, while they're hated, and while the markets just want nothing to do with them. But more importantly, there is a long-term investing thesis. Roughly 10,000 Americans turn 65 years old every single day. Now, to put it into perspective, back in 2004, about 1 in 8 Americans were over the age of 65. In 2024, friends and family, it's now nearly 1 out of 5. Now, here's the crazy thing. By 2033, it is predicted that more than 1/5, 20% of the entire US economy will be dedicated to health care. So what I'm trying to say is, even when there's layoffs, even during the pandemic, even during catastrophic events, healthcare is always hiring because of the aging population growing and the elderly living longer than they did in the past, which means they require more care. So healthcare stocks for me right now, I'm pretty bullish on. I mean, it's just human biology. We're not meant to live 95, 98, 99 years old, right? But we are thanks to the advancement of medical technology, healthcare products, and of Abbott's offerings. So it is a position that I'm going to continue to dollar cost average as they trade flat or even go into the red. I'll be picking up more shares. My conviction level for Abbott is pretty darn high. Other than that, taking a look at the cheese portfolio's dividend situation. Right now, the dividend payout for 12 months is $455, or per day is $1.25. I think that's enough for me to call it a day and retire. No, I'm just kidding. $1.25. It looks like coming up in May, we got Procter & Gamble and SAP paying pretty juicy dividends, $57 from Procter & Gamble, and then just shy of $30 from SAP. So all in all, the portfolio, 6 positions. Now moving on to the second portion of the video, a question that pops up from time to time is, why do I own so many different stocks? Because some people believe the ideal portfolio should only have 2 to 3 stocks, or even less, maybe just 1. To put it into context, the reason why sometimes people say that is because at one point, the cheese portfolio was pushing, I think like 13 or 14 holdings. So I did have a lot more than we do today of 6. So to answer that, look, I definitely agree with the sentiment that less is more, and keeping things simple is better than overcomplicating matters. Right now, I'm in the used car market, and I'll tell you what, even though the prices are all jacked up and it's making me lose my hairline, one thing that I do appreciate about cars that were made in the 2000s versus today is that we used to have physical buttons you could press, and it was pretty darn simple, right? In 2026, almost every single vehicle sold in the US is now coming with a 15-inch iPad front and center. And that's the only thing that gives you access to the HVAC, to the radio, to anything. And so if that goes down, everything goes down in the car, and it just overcomplicates stuff. I think by adding all of the bells and whistles and technology in 2026 into the cars, that just gives more friction points for things to break down and for repair costs. Whereas with a physical button that you can press on or off, that you can touch with your dingy little index finger, it's so much easier to replace, especially if the paint on it gets worn. It's easy to just paint it back on. With touch screens and all this technology crap, I don't know, I just think we're overcomplicating stuff. But anyways, I digress. As a loose rule, when it comes to portfolio management, I try to keep the cheese portfolio at about 10 holdings. And I think right now at 6, we're well below that. And that's because it's not 100% a hard black and white rule. For full transparency, sometimes this is going to get as high as like 15 or 18 holdings depending on the situation and scenario. Even though it's not a hard rule, I would like to keep it around 10 or so holdings. And on the flip side of that, when things get out of control, when things get a little wild, like it did when I first started to get into investing in 2019, I think I had like 80 different holdings. And that's because I bought 3 to 5 stocks in every single sector to create my own version of VU. And dude, I will tell you right now, it was chaotic. And so thinking about that time frame, and from my past experience, I don't want to get to a point ever where the cheese portfolio turns into 100 different positions. Because I learned from firsthand, when you do that, you diversify away your performance, your gains. While at the same time, if I only have like 2 positions and I hold too little variety, that's also baking in way too much risk. And what I mean by that is, imagine if this portfolio right now was only Microsoft and The Trade Desk. So 50% Microsoft and 50% Trade Desk. Trade Desk, I am down 50%, which means my portfolio's performance would be absolutely atrocious. So when you only have 2, 3, or 4 holdings, even if your conviction level is really high, there's a probability, and statistically it says that you could be in the gutter if one of them goes into the red. Luckily, I do have a few positions that help this bleeding look a little less red, but who are we kidding? 5 out of the 6 positions are in the red, and that's because I just entered them in the past like 2 or 3 months, so it's okay. They're all short term for the time being. You look back 3, 5, 10 years, I'm sure things would be okay. However, the bigger reason as to why I'm against the idea of having 150, because I know some of you watching this, you probably have 120, 180 different stocks, it's that it's a ton of effort and time and dedication to stay up to date on the business operations as an owner. Because I don't just think of these as a ticker symbol that I just buy and swing trade or day trade. No, I'm in it for the long run. And I like to think of it as I'm an investor of their operation. And so staying up to date on my positions, that's the reality. And that's a requirement of picking and investing in individual stocks. You have to know when it's time to sell, whether the business is struggling, management loses its way, or for instance, Microsoft could come out of the blue and be like, hey, we're exiting every line of our business, the cloud, Azure, and gaming division. We're selling it all, and we're going to start selling baby clothes. Like, they could do that. I'm not going to say it could happen, but statistically it could. For me, that's enough to sell out of them. I don't care how deep in the red I am or how much green there is, I'm out. So if the thesis changes, you got to stay up to date to figure out whether or not it's the same business that you invested into initially and if the investing thesis still makes sense. Or if the valuation simply becomes too detached from reality, like let's say my fair value estimate for Microsoft is $200 and they're currently trading for $407, they're almost 2x that, right? So for me, I would sell them and capitalize on the gains. All that to say, individual stocks investing, it takes a lot of effort. And circling back to the idea that less can be more, I don't think it makes much sense to own 10 different flavors of the exact same investment. For example, buying Vanguard's VU, SPY, and IVV all at once. All of those ETFs, they track the S&P 500. And they're essentially the exact same thing. So if I see that in a portfolio, the first thing that I would do is frown, because it's redundant, it's repetitive. On the other end of the spectrum, I'm also against diversifying just for the sake of diversification. So if that means I end up more concentrated in a few sectors that I genuinely understand and have conviction in, I'm okay with that. Like if we hop on back over to the homepage, you'll see that I only have positions in tech, consumer staples, which is represented by Procter & Gamble, and healthcare. I don't have exposure at the time being to industrials, to restaurants, to the very trendy semiconductor or memory storage stocks, to military stocks. No, it's very concentrated, and I'm okay with that. And that mindset of being really picky, it also affects how I approach new positions. If I'm on the fence about a stock, like I don't know if I want to do it or not, and I sleep on it and I think about it for days on end, if I'm not willing to hold it for the next 10 years, then I usually pass on it. Because I've learned that being patient and selective and waiting for the opportunities that are too good to pass up, that I truly believe in, that has served me far better over the long run than it is to FOMO and jump into a position that I'm just like half-baked or half willing to hold on. And I think that's why when I finish analyzing and researching a company, I give them a stamp grade, ranging from S all the way down to an F. So what I'm saying is if a company at the end of the day, I like certain aspects about them, but then there's also characteristic traits that I don't like, and it rounds out or it shakes out to about a C or satisfactory around a 70-75% out of a scale of 100%. 100% meaning I need to be invested into them because they're the next biggest thing and I truly believe in them, such as like Amazon, Google, or Microsoft. But if they're like a 70%, I won't jump in. I'll just walk away. I'll put them on the watch list and I'll wait to see if they can move up to 80-85%. But that's why it's really important. Whether you do individual stocks or if you invest into ETFs like passive investing, it's important for everyone to have a watch list. That way you can systematically dollar cost average into positions that you really want to when there's a market-wide correction or when everything goes on a sell-off. That way you can go down the list and say, okay, this is priority number 1, priority number 2, priority number 3, and so forth. Just to throw it out there, for who I am right now in the wealth building and accumulation phase of my life where I'm trying to get this portfolio as big as possible, if there is a market-wide crash and everything goes 40-50% off, the 2 ETFs that I would go gung-ho on, SCHD and SCHG. Now, on the other hand, if I was retired and I was an income investor, then I go all out into GPIQ, which is the Goldman Sachs covered call ETF that generates a monthly income. All else being equal, that's my mentality. So the biggest takeaway is this. If you own too many holdings in your portfolio, you dilute your gains. And believe it or not, I actually made 2 separate videos on this topic. So if you want a deeper explanation, go and check those out because there's definitely more meat on the bones. That's a little bit more academic. Because right now I'm just spitballing and talking about my portfolio while addressing some of the questions you guys have been asking when it comes to portfolio and stock picking management. Changing gears a bit, let's move on to the last segment of the video. Compounding only works if you give it time. What I'm saying is, when it comes to dividend compounders, they need time in the oven. You wouldn't necessarily put a rack of ribs on the grill or a baking sheet full of cookies and only put it there for a minute and then pull it back out and look at it every 10 seconds. No, you need to give them time to bake, to marinate, and to let the juices build real flavor as they compound. Slow cooking something over time, that's how you get the best flavor, right? For instance, if we take a look at Cisco, which used to be a core holding of this portfolio, I bought into them right here at around $42, $43 a share. And as we fast forward, they moved up to around 47, moved down to 46, went up, went down, went up, went down. But from my cost basis of like 43 bucks a share, they didn't really do much for a year, for about 2 years. And then look at what happened with due time. The narrative changed, and Cisco became a critical ingredient to the physical infrastructure supporting the data center movement. And then once they reached $89 a share, I think at $88.50 I sold out. I sold out because my fair value for them is $88, and they're currently $99. Yes, I could have held on for a little longer, but I'm completely happy with the returns that I received with Cisco because if you zoom out and take a look at their full timeline, I'm not trying to insinuate that this is going to happen again, but during the dot-com bubble crash, Cisco ballooned up in valuation to around like $80 or $81 a share, and then immediately afterwards, when the bubble burst, they crashed so freaking hard, right? So if you had bought into Cisco at $80 a share back in the year 2000, it would have taken you almost 26 years to break even and then go out in the green by a little thin margin. Not saying that that's what's going to happen, but for me, having bought into them around this price point right here, I'm happy to let them go and they can ride further to 100, 105. I'm not going to get FOMO. That's why I treat my core holdings with patience. Sometimes it takes time for them to do great things. That's why as I take a look at my positions, I'm not sweating. I know in due time, I'll be okay. Now between you and me, I'd be lying if I said I never made short-term trades, because I absolutely do. Sometimes I buy into a very oversold stock because of their earnings and they go down by like 30%. I'll buy into them. And then by the following week, they've already recovered. I do stuff like that from time to time. But for the most part, I enter positions with a long-term mindset and horizon and a clear understanding of what would actually make me sell, such as once they reach my fair value estimate. Now, on the other hand, if I was messing around with options or puts and calls that expire in the next 48 hours, of course I would be sweating. Of course I would be nervous. But when you buy and hold shares of a high-quality compounder, more often than not, what I have seen is I come out ahead. I come out okay. The question is, do I have the patience? Do I have the stomach to be able to endure through the volatility, through the ups and the downs. Why am I saying this? Why am I preaching to the choir that's clapping their hands in the back? Because I'll tell you this. If you look at my high conviction picks on this channel, the stocks I genuinely believed in and bought into, the comments section, yes, there were some others that believed in the vision because they did their own due diligence and research, but it was full of doubt, skepticism, and a handful of folks questioning why I would buy a falling knife. But that's the thing about compounding. It rarely looks exciting in the beginning. The market tests your patience before it rewards your conviction. It takes time. Sometimes when you buy into something, it could immediately go further into the red by another 5, 10, 15%, like what happened with Microsoft very recently. But if we zoom out and take a look at the channel's picks historically in the past few years, let's talk about AMD. Some of you guys remember exactly what I'm talking about. Do you remember when I aggressively bought them around 120 per share? Right around this point right here at the end of 2024 when they were selling off? I know. Buying into that, I began to question whether or not I should just call it quits and just default to ETFs. Because immediately after buying into them for 120, they dipped all the way down to 85. And yes, I dollar cost averaged all the way down. And I vividly remember people questioning my decision making by investing in Advanced Money Destroyer. Well, if you take a look at what happened since I bought into them, I mean, obviously I sold out of them for a fat profit, but $120 a share when I initially bought into them, and now they're $448 a share. As soon as I bought into them, yes, they did go on a massive sell-off. But at the time, the investing thesis was absolutely intact. They were player number 2 behind NVIDIA for the data center movement. And once all the hyperscalers were announcing their CapEx plans, I was like, oh my goodness, I think this is a golden opportunity. And so I put my money where my mouth was. My only regret? Selling out of them. Had I done nothing and just held on to them? Yeah, the total return would have been a lot higher, but you live and you learn. And then also not too long ago, do you remember how I was going on and on about the military and defense stocks when sentiment was super weak because of the CapEx concerns and the delayed backlog deliverables and the Doge administration? While at the same time, I knew with the current administration, the military stocks were absolutely undervalued and I bought into them. Let's talk about Oshkosh Corporation. This is a company where I bought into them right here at about $94, $95 a share, and they went all the way up $180 a share. But just like AMD, immediately after buying into them, they got absolutely hammered alongside with the rest of the market because of the tariffs and the debacle associated with that. And then there was also Huntington Ingalls. Now this one I have very positive feelings for because I think my total return for them was like 140%. They essentially make every ship, carrier, destroyer, and submarine for the United States Navy and Coast Guard. They have an economic moat beyond belief. And I remember buying into them at this price point right here. I think my cost basis was what, like 170, 172? So I did not cash them at their absolute lowest. But with due time, what happened to Huntington Ingalls? They went from $160 all the way up to $460 a share. Now, did I time it perfectly and sell out of them at $460? No. I think I sold out of them like right here at like $405 or $410, but still a pretty good ROI. And then in 2025, I think some of you found this channel because I was the guy on YouTube talking about United Health and other health insurance stocks. Because everybody thought they were going to go belly up with the current administration threatening to cut funding to get rid of them. And the health insurance stocks as we know them today, they're going to be gone. No longer. When I saw that happening, I pumped the brakes and I was like, well, hold on. If you take a look at their financials and fundamentals, United Health is in the S tier when it comes to the health insurance stocks. I bought into the fear. And when I bought into the fear, Did it feel good doing it? No, I also questioned whether or not they were going to go further down to $199. Now, fortunately, they did not. My cost basis was around like $260, so I didn't time it perfectly at the bottom, but pretty much near the bottom. And if you take a look at their performance in the past, 3 months, 42% into the green, past 1 month, 30% into the green, they eventually recovered and they're doing great now. Did that happen overnight after buying into them? No, it took time. The other one that I bought into was Centene Corporation. They do a lot of Medicare and Medicaid for the state of California. And if you take a look at their short-term performance, they're also crushing 59% into the green past 30 days. Past 90 days is 46%. I also bought into them right here because I was like, wait, their valuation at the time, I think their PE ratio was like a 4. A 4! Can you imagine that? So I bought into it. I was like, you know what? I think the floor here has been reached. But the ceiling, my fair value estimate for Centene was $45 a share. Now they're currently $59. And so the health insurance landscape, it's business as usual. They're back to normal. I don't think they're undervalued anymore. I think every single one of them across the board, fairly valued. But had you bought into them like 11 months ago, 10 months ago, you had the opportunity to buy into them when they were 60 to 70% off. But that ship has sailed. Don't worry, there's always opportunities in the stock market because sector rotations happen every single quarter. And as of right now, the medical device space, they're getting demolished. They're getting hammered. That's why I put my money into Abbott. In fact, there are countless other examples on the channel, right? It's just, I feel uncomfortable, and it's not my nature to show off and brag about my wins. If you are a friend of the channel, then you know that I usually hyper-focus and talk about my losers instead, which, between you and me, that's my toxic trait. Because I tend to be a pretty positive, uplifting guy, always thinking on the bright side of things, but when it comes to my stock market wins and losses, I always gravitate towards conversating about the losers. I don't know what it is. All that to say, great things take time to happen, both in stocks and in real life. If you work out once, you're not going to see any difference. You're not going to get a six-pack just because you went to the gym for 15 minutes one time. But if you work out consistently and you stay patient with the results, a year from now, 2 years from now, you'll look completely different. The same applies if you're trying to control your temper, your anger, or even your urges. Growth rarely happens overnight. Unless you're into speculative day trading or you like to invest into hype. We don't do that here on this channel, but if you do, I don't blame you, right? Everybody has a different risk profile and tolerance. For me, I'm pretty conservative with my investments because I would rather not have the potential of 5xing my money or losing everything in one options contract. I would rather not play that game. I'm happy with getting 20, 30, 50% gains. So to hammer the point, growth rarely happens overnight. It comes from repeated discipline, small decisions made daily, and having the patience to keep doing the little things so that you don't make a fool of yourself at a Costco food court when they mix up your order and you start shouting at the person that's making minimum wage, or when someone cuts you off in traffic. You'll look ridiculous. Likewise with stock investments, patience. Sometimes it takes 3, 5, or 10 years for the investment thesis to play out and to see like a 100%, 200% total return. It's not going to happen in a week, unless of course you timed the bottom perfectly with the health insurance stocks and you saw a 59% return in 30 days. Okay, that's there. That's the exception. That's an outlier. That's not normal. Boys and girls, ladies and gentlemen, the word of the day is patience. It's one of the best virtues you can practice and try to master. Now, having said all of that, I would greatly appreciate it if you could click like on the video. It would help out the channel. And good luck in the stock market. Stay safe, and I will talk to you guys next time. See ya.